Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. The Tale of Two Markets: Market Volatility, Tech Valuations, and AI Monetization. This video presents a direct informational narration of the source document. Right now, we're witnessing an absolutely fascinating dynamic unfolding in the financial world, what's basically a tale of two markets. On one hand, we've got this stark, almost palpable panic hitting the semiconductor sector. I mean, these were the absolute darlings of the market just weeks ago, and suddenly they're seeing severe technical breakdowns. But then you pan out and look at the broader market, and there is a surprising level of stability and breadth. So how do these two realities actually coexist? What's driving the massive borrowing by tech giants lately? And what does the whole shebang tell us about the future of artificial intelligence? Well, let's dive into the data and unpack exactly what's going on.
Here is our roadmap for today. We're going to start with macro forces, then hit the semiconductor sell-off, Amazon's bond issuance, SPX valuations, tech price targets, and finally, wrap up with market support levels.
Section 1. Macro Forces, Oil and Inflation.
Okay, before we can really wrap our heads around the tech stock panic, we have to talk about the broader economic pressure cooker that's currently fraying investors' nerves. The June New York Fed Consumer Survey revealed a really intriguing divergence in consumer psychology. Get this, the one-year inflation expectation ticked up to 3.7%, which is actually the highest level since September 2023. So people are absolutely feeling the pinch right now, and they're expecting short-term pain. But on the flip side, the five-year inflation expectation? Completely stable at 3.0%. The crucial takeaway here is that while consumers are super anxious about near-term price hikes, their long-term inflation expectations remain solidly anchored. Plus, the market is currently pricing in an over 80% probability of a single interest rate cut by 2026. This specific mix, short-term uncertainty paired with long-term stability, is exactly the kind of environment that fuels market chop.
And speaking of short-term pressures, we need to talk about oil, specifically $75. That is the recent bounce price for Brent crude oil, jumping from around 70 straight up to 75. The catalyst? Geopolitics, pure and simple. We're seeing renewed tensions in the Middle East, specifically some incidents in the Strait of Hormuz involving commercial vessels. That actually prompted some rapid diplomatic and licensing responses from the US regarding Iranian energy sales. However, our source points out that while these headlines cause short-term spikes, a massive sustained upside shock, like shooting back over $100, is highly unlikely right now. Why? Because it's an election year. Election year dynamics generally mean incumbents want to avoid any crazy, dramatic price spikes at the pump right before voters head to the polls. So realistically, expect oil to bounce around in that $70 to $90 range rather than shooting to the moon.
Section 2. The Semiconductor Sector Sell-Off.
Now, this is where the real drama is unfolding. The semiconductor sector basically went from being the market's golden child to its biggest victim almost overnight, highlighted by a sharp 5% single-day drop in the semiconductor index. But honestly, it's not just that percentage drop that matters. It's the structural breakdown. The index opened at 551, completely falling through the absolutely crucial technical support level of 554. This wasn't just some gentle, routine pullback. This was a clean, undeniable break of a major floor. And when a sector breaks technical levels that cleanly, it confirms a broader retracement trend. It immediately shifts the market psychology from buy the dip to sell the bounce.
To really understand why this breakdown has been so incredibly vicious, we have to look at trading volume. The source captures this perfectly, stating, highly leveraged positions are turning potential long-term holders into panic sellers. June saw massive, historic trading volume in semiconductors, and it essentially created a classic trap. As prices stayed sky-high, investors just kept piling in, heavily utilizing leverage and options. So when that technical breakdown occurred, all those shares bought at peak prices in June instantly turned into trapped liquidity. And because these positions are highly leveraged, those investors don't have the luxury of just sitting back and waiting it out. They are facing margin calls. So now, any slight rebound in price is immediately met with immense selling pressure from those trapped buyers who are desperately trying to exit or deleverage. It literally creates a vicious cycle of forced selling.
Section 3. Amazon's massive bond issuance.
So, when the tech sector faces this kind of intense pressure, what do the mega caps do? They aggressively raise capital. The sheer scale of Amazon's global borrowing right now is staggering. They aren't just tapping the US market, they are hunting for liquidity everywhere. Back in March, they issued $37 billion in US dollar debt, which is actually one of the largest corporate issuances in history. But they didn't stop there. They followed that up with roughly $16.6 billion equivalent in euros and then hit record levels in the Swiss franc and Canadian dollar markets in May and June. Add it all up, and they've raised nearly $82 billion recently. And the demand for this debt? Absolutely massive. The latest tranche actually saw demand at 2.5 times the target. So why is Amazon borrowing all this cash across the globe? To fund a projected capital expenditure of nearly $200 billion just to build out infrastructure.
And that mountain of debt leads us directly to this core concept, AI monetization. Amazon and companies just like it are taking on massive debt loads to build out artificial intelligence infrastructure. They are deep in the heavy investment phase. But, as we all know, debt has to be repaid. AI monetization is the critical next phase where these billions of dollars must actually start generating sustainable, profitable returns. The big debate going on right now, and a huge source of underlying market anxiety, is whether this aggressive capital expenditure will hold up, or if the growth rate of these investments is going to need to dramatically slow down if the profits don't materialize fast enough.
Section 4. SPCX Valuation Divergence.
This immense pressure to monetize is actually warping Wall Street's ability to value tech companies. Just look at the 12-month price targets for SPXY, which recently entered the NASDAQ 100 index. They are truly mind-boggling. On one end of the spectrum, Morgan Stanley gives a fundamental valuation target of just $62. But on the absolute extreme other end, an outlier analyst set a target of $800, with the average sitting right around $236. Why the massive disconnect? Well, a huge part of it comes down to index inclusion. When a stock enters a major index like the NASDAQ 100, it triggers automatic buying from passive tracking funds and quant models, completely regardless of the company's fundamentals. This passive flow creates immense short-term pricing anomalies, totally disconnecting the stock price from traditional valuation metrics and leading to these wild, all-over-the-map Wall Street targets.
Section 5. Tech Stock Price Targets.
So if the broader semiconductor index is breaking down, which specific companies are flashing the brightest red warning signs? The source highlights two major semiconductor equipment manufacturers that are currently deemed severely overvalued. First up is Applied Materials. Even with recent drops, the forward valuation suggests its strong support level doesn't even kick in until you drop below $459. Similarly, Lam Research is flagged as severely overvalued, with its significant technical support sitting way down below $272. Let's be crystal clear on what this implies. If the semiconductor sector continues its pullback, the downside risk for these highly extended names is incredibly steep before they actually hit a genuine valuation floor.
Section 6. Broader market support levels. Okay, take a deep breath. We've talked a lot about the panic in tech and semiconductors, but is the sky falling everywhere? Not quite. And this number, 7312, is key. It represents the median 2026 forward price-to-earnings target for the S&P 500. While the tech sector is going through a violent shakeout, the broader market breadth remains surprisingly resilient. The source points out that even on a day when tech was bleeding, the S&P 500 still had more advancing stocks than declining ones. This tells us we're actually seeing a sector rotation, money moving out of overvalued tech and into other areas, rather than some total flip-the-table market panic. The broader market is treating this as a necessary, albeit painful adjustment, with 7312 serving as a logical, fundamentally supported median anchor point for the near future.
And that brings us to our final thought. We've seen the shaky macro data, we've seen the technical breakdowns trapping leverage buyers, and we've seen the literal mountains of debt being piled up by megacaps to fund their infrastructure. It all funnels down to this one provocative question. Will the reality of AI monetization ultimately justify these towering market valuations? Because if AI delivers massive profits, this tech pullback is just a bump in the road. But if the monetization phase stumbles, the downside risk we saw in those support levels could become a harsh reality.